Hi, this is Raman Gill. Welcome to another episode of the 10,000 Trades Show, where we are mastering trading and creating excellence through the deliberate practice and analysis of 10,000 trades. Today, we'll take a look at how to identify an inefficient market move. Inefficient market moves are created by a quick move of the price, which creates a vacuum in the market. Anytime there's a vacuum, prices will come and fill that vacuum. So this is the same thing with gaps as well as inefficient moves. So let's go on to the charts and we'll take a look at what an inefficient move looks like, where to enter the trade, where to place our stop loss, and as always, where to exit the trade with a profit. Here we're looking at how to trade an inefficient market move. This is dollar-yen 15-minute chart. An inefficient move is when price takes off quickly. So in this case, we see price comes into the support level here, and then it just blasts off in the upwards direction here. Generally, these kind of moves happen when there's a comment that comes out on the news, or there is some sort of a quick news that comes out and market has a knee-jerk reaction. And as the market digests this information, it then goes and fills the vacuum that was created by this quick sudden move to the upside. And generally, it will tend to come back to exactly where the whole thing started. So in this case, first thing is we need to identify the inefficient market move. And here we see that price moves up very rapidly. This is a 115-minute candle. So price just takes off to the upside here. And then generally we'll see a lot of the inefficient moves will have these pins on top, which just shows us that there's no momentum left to the upside. So we see a large pin to the upside and price doesn't even go and test this level. Once again, starts to pull back here. And as we can see, price just stays below this support and resistance level, does not even hold above here. So this is a good sign that price is likely to drop. So we want to see a good candle close. In this case, we see a nice bearish candle close below our S2 level or S3 level on the pivot point. So we take the entry short. So this is a bearish move here. We're looking for price to fill this inefficiency. So we are going short. We enter the trade short. Our stop would go above the pin here, just in case price decides to go and test this level once again. And we stay with the trade as price moves lower. Our take profit target would be where the price started from. In this case, we put it just before our support level here. So from entry to exit here, we get 40 pips in our trade. Just to recap here, an inefficient market move is where price takes off to the upside very, very rapidly. And these moves tend to be created by some comment or news. So we're looking for price to come and fill this inefficiency. So the inefficient moves generally creates a vacuum in the market because price moves so rapidly. It's like an elastic band. It then snaps back into where it's supposed to be. So once we see that price starts to move back down here, it doesn't want to stay up here. This is a good indication that price is likely to move lower. So we can take the entry short here. And now we're looking for price to come back down here. And our exit would be just before price started to move upwards here, just above our support level. From entry to exit here, we get 40 pips in our trade. So our profit is 40 pips or $400 if trading one standard lot. I hope you enjoyed this episode. If you would like to see more great trade setups like this one, I invite you to like, comment, and subscribe to the channel. That's it for today. I'll see you next time.